Open a ZERODHA account. 7 Markets and Taxation Chapter 1. Introduction, Setting the Context Chapter 2. Basics Chapter 3. Classifying your market activity Chapter 4. Taxation for Investors Chapter 5. Taxation for Traders Chapter 6. Turnover, Balance Sheet, and P&L Chapter 7. ATR forms the finale. About, Pipe, Lot. Open a ZERODHA account. Chapter 1. Introduction, Setting the Context. I remember a time, maybe about 6 years ago, I had the opportunity to meet one of those hard-to-find chartered accountants who knew both taxation and markets quite well. It was at a friend's party that I got introduced to him. He asked me what I do for a living, to which I promptly replied that I trade for a living. We immediately struck a chord and had a great conversation going. Somewhere during that engaging conversation, he asked me a few questions. How would I declare my profits and/or losses from my market activity? Do I bifurcate between speculative business income and non-speculative business income? Also, he asked me about the books of accounts that I'm supposed to maintain. Thanks to my ignorance, I had no answers to give him. I was an eager learner, as I spent all my time learning about the markets and trading strategies, but spent very little time learning about taxation and its relevance to market participants. Probably the reason why I consciously ignored learning about taxation was because I always feared the heavy usage of jargon, random references to sections, subsections, circulars, and whatnot. To my defense, I once did honestly try to learn about taxation. I paid a visit to my broker's office and met my dealer and questioned him on taxation. This is what he had to say. 3. Why are you so worried? Long-term capital tax is 0% and short-term capital gains tax is 10%. That's it. It is a simple matter. I for sure knew it was not just that. I insisted to meet someone more knowledgeable to understand the topic in greater detail. To my luck, I got to meet the regional head of the stockbroking company. Enthusiastically, I picked his brains about taxation for market participants. Unfortunately, even he reiterated the same thing that my dealer had told me. It seemed even worse, as the regional manager had a sense of pride while he gave me that sloppy answer. Frustrated, I visited a CA and he essentially said the same thing that my dealer said. But he used fancy jargon and complicated the whole matter to no end. At that point in time, nobody had blogged about it online. No good articles were written on the topic, and thus my quest to learn taxation related to markets got squashed like a bug. In retrospect, had I known more about this topic, had I got more information, I would have clearly benefited in multiple ways. I'm certain there are many traders and investors in a similar situation as I was few years ago. In fact, this is true considering that our blog on taxation, which was put up a few years ago, has received over 2,000 questions. This number is besides the numerous emails received and queries asked on Trading Q&A. Keeping this in perspective, we are happy to introduce our new module on Zero to Varsity, aptly titled Markets and Taxation. The module deals with literally everything that you need to know about taxation related to markets, be it short-term capital gains, or treating your intraday trades as speculative business income, or about Section 44 AD, we have it all on Zero to Varsity in one place. Concise and simplified. Now here is the best part: the whole module is authored by Nathan himself, which means that we get to learn about taxation from a trader, investor's perspective and not really from the CA's perspective. This makes a huge difference in terms of topic narrative. With a seasoned trader discussing taxation, we get to learn about the essential topics without digressing into the taxation wilderness. Lastly, if I look back in time, I could not imagine brokers giving out such valuable information to clients. In fact, stockbrokers were always known to hoard information and pass it only to select clients. I'm sure you would agree with me on this, especially if you have been trading the Indian markets for a while now. Stockbrokers in India have always been snobby, expensive, and full of unwanted attitude. However, the stockbroking industry is slowly waking up to the fact that the customer irrespective of his size, deserves the best. This change in attitude is leading to a revolution of sorts in the industry, and I do believe Zerodha is the epicenter of this revolution, changing the way the Indian broking industry functions. Be it providing you high-quality tools to trade, better trader education, or ready-to-use tax-friendly reports, Zerodha has it all for you. So please do go ahead and explore this unique module on markets and taxation. I can assure you that the content presented here will make you more confident about matters related to taxation. And with that newfound confidence, you will never have to fear the tax man. Stay connected. Stay profitable. Kartik Rangappa. 31 responses. Open a Zerodha account. Chapter 2. Basics. 2.1 Overview. India needs help from all of us countrymen in developing a tax culture. The fear about income tax department can be removed only by gaining knowledge on all the basic rules and regulations. Income tax rates in India have drastically reduced from over 90% in the early 70s to now 2015, where no tax has to be paid on annual income up to 2 rupees and 50 paise LKS. But the apathy of taxpayers towards filing income tax returns and paying taxes continues till today. With the systems used by the IT department becoming sophisticated every year, the chances of repercussions in terms of notices and penalties due to non-filing, misfiling, and hiding information while filing your income tax returns (ITR) is going up significantly. Similar to how income tax IT department has access to all your bank account details, they can also check upon all your capital market activity easily through the exchanges, as they are all mapped to your PAN permanent account number. Check this notice received by a client who hadn't declared his trading activity on commodity exchanges in FY 2012-13. The notice was sent only in 2015 asking for an explanation. Check this link that has a list of various codes in which these notices are sent by the IT department, even if the intent is there to be compliant. Most people, including many chartered accountants, CAs, don't understand the subject of taxation when investing and trading very well. We had put up blog post Taxation Simplified on Z-Connect a few years back, simplifying key aspects of taxation for market participants. Over the last 2 years, we have received a few thousand queries on the post. Answering all of them, it was obvious that we had to do a lot more to simplify all aspects around taxation while trading or investing in the markets. Hence this module. If you only invest into stocks or mutual funds, filing returns is quite simple, but can get tricky if trading intraday stocks or financial derivatives, futures and options. We will in this module break all the concepts down into small, easy to understand chapters without any of those jargons typically used by CAs or tax consultants. Here is a sneak peek into what you can expect going forward in this module. Introduction, setting the context. Basics. Classify your market activity. Taxation for investors. Taxation for traders. Turnover. Balance sheet. And P&L. ITR forms the finale. 2.2 What is income tax? It is a tax levied by the Government of India on the income of every person. The provisions governing the income tax law are given in the Income Tax Act, 1961. In simpler words, income tax is a portion of money that you earn paid to the Government of India. Why should I pay tax? Yes, India does not offer social security and free medical facilities as being provided in some developed countries. But the government needs funds collected as taxes to discharge number of responsibilities like government hospitals, education, national defense, infrastructure development, just to name a few. Who is supposed to pay income tax? Income tax is to be paid by every person who earns more than the minimum income slab set by the government. The term person, as defined under the Income Tax Act, covers in its ambit natural as well as artificial persons, including corporate. Only 2.9% of over 121 crore population are taxpayers in India, compared to over 45% in a developed economy like USA. Part of the reason for such an abysmally low number is also because many Indians don't earn enough to qualify to pay income tax. But the larger factor has got to do with lack of tax culture. Taxes have to be paid based on how much income you earn every financial year. Financial year in India starts from April 1st and ends on the 31st of March. Do note that year can be specified either as financial year (FY) or assessment year (I). FY is used to denote the actual year the income was earned for which you are filing taxes. So FY 2014-15 is the financial year starting April 1st, 2014 and ending the 31st of March 2015. I is used to denote the year in which you are supposed to file your taxes. So I 2015-16 is the year when you file the returns for income earned in FY 2014-15. So I 2015-16 and FY 2014-15 are one and the same. So you will use ITR with I 2015-16 on it to file your taxes for the income earned in financial year starting April 1st, 2014 and ending 31st March 2015. 2.3 Income tax slabs in India for financial year 2014-15. All Indians have to pay taxes on the total income earned every year as per the below tax slabs they belong to. If you are salaried, your employer would already be paying taxes on your behalf to the government and issuing you a Form 16 as an acknowledgement for having paid the taxes. Your employer will not have access to all your sources of income, like bank interest, capital gains, rental income, and others. You are supposed to use the Form 16. Add all your other income, calculate and pay any additional tax, and file your income tax returns before due date every year. The tax slab for individuals FY 14-15 is as below. Individual, age up to 60 years. Income slabs tax rates. 0 rupees and 50 paise LKS nil. 2 rupees and 50 paise LKS, 5 rupees LKS 10% of amount by which income exceeds 2 rupees and 50 paise LKS. 5 rupees LKS, 10 rupees LKS Rs. 25,000 plus 20% of the amount by which income exceeds 5 rupees LKS. 10 LKS and above Rs. 125,000 plus 30% of the amount by which income exceeds 10 rupees LKS. Senior citizen, age 60 to 80 years. Income slabs tax rates. 0 rupees LKS nil. 3 rupees LKS, 5 rupees LKS 10% of amount by which income exceeds 3 rupees LKS. 5 rupees LKS, 10 rupees LKS Rs. 20,000 plus 20% of the amount by which income exceeds 5 rupees LKS. 10 LKS and above Rs. 120,000 plus 30% of the amount by which income exceeds 10 rupees LKS. Super senior citizen, age 80 years and above. Income slabs tax rates. 5 rupees LKS nil. 5 rupees LKS, 10 rupees LKS 20% of the amount by which income exceeds 5 rupees LKS. 10 LKS and above Rs. 100,000 plus 30% of the amount by which income exceeds 10 rupees LKS. From the next chapter we will start focusing in detail on all aspects of taxation when trading and investing in the markets. Key takeaways from this chapter. Filing correct income tax returns is the duty of every Indian. The Income Tax Department has access to your market activity. Only 2.9% of Indians are taxpayers. Financial year FY is the year income was earned. Assessment year I is the year you file your taxes on the income earned. Financial year is between 1st of April of the current year and the 31st of March of the following year. The income tax applicable to you depends on the income tax slab you belong to. The income tax slabs vary based on your age group. Disclaimer: do consult a chartered accountant (CA) before filing your returns. The content above is for your general knowledge only. Content meant for individual retail investors, traders in India. 13 responses to basics. NITHUN Gout. Open a ZERODHA account. Chapter 3. Classifying your market activity. 3.1 Are you a trader or investor or both? Identifying yourself as a trader or an investor is the first step to file your income tax returns. This may seem like an easy task. But here is what this circular from CBDT, Central Board of Direct Taxes, says. If you buy shares with the intent of earning income through dividends, you are an investor. And if you buy and sell shares with the intent to profit, you are a trader, smiley face. Yes. That is how vague it is. And this is a circular dated 2007. Released after 18 years of the original circular. Numerous judicial pronouncements and government was still unable to clear this highly debatable issue. Thanks to the vagueness of this circular, it has given too much power in the hands of the assessing income tax officer, especially. Considering the fact that most of the stock purchases are done intending to profit from the price appreciation. Updated the 2nd of March 2016. Finally, the Income Tax Department has brought in clarity in classifying yourself as a trader or an investor. Equity delivery trades through this CBDT circular. It now says that an individual can decide on his own to either show his stock investments as capital gains or as a business income trading, irrespective of the period of holding the listed shares and securities. Whatever is the stance once taken, the taxpayer will have to continue with the same in the subsequent years. So before filing income tax returns, you will have to first classify yourself as an investor, trader, or both. We will in this chapter help you figure this out in line with what most AOs would be expecting. By income I mean both profit classifying your market activity. 3.1 Are you a trader or investor or both? Identifying yourself as a trader or an investor is the first step to file your income tax returns. This may seem like an easy task. But here is what this circular from CBDT, Central Board of Direct Taxes, says. If you buy shares with the intent of earning income through dividends, you are an investor. And if you buy and sell shares with the intent to profit, you are a trader, smiley face. Yes. That is how vague it is. And this is a circular dated 2007. Released after 18 years of the original circular. Numerous judicial pronouncements and government was still unable to clear this highly debatable issue. Thanks to the vagueness of this circular, it has given too much power in the hands of the assessing income tax officer, especially. Considering the fact that most of the stock purchases are done intending to profit from the price appreciation. Updated the 2nd of March 2016. Finally, the Income Tax Department has brought in clarity in classifying yourself as a trader or an investor. Equity delivery trades through this CBDT circular. It now says that an individual can decide on his own to either show his stock investments as capital gains or as a business income trading, irrespective of the period of holding the listed shares and securities. Whatever is the stance once taken, the taxpayer will have to continue with the same in the subsequent years. So before filing income tax returns, you will have to first classify yourself as an investor, trader, or both. We will in this chapter help you figure this out in line with what most AOs would be expecting. By income I mean both profits and losses. When trading or investing, you need to classify your income under one of these heads. Broadly speaking, they are long-term capital gain (LTCG), short-term capital gain (STCG), speculative business income, non-speculative business income. Let us understand what each of these mean. Long-term capital gain (LTCG). Assume you buy stocks or mutual funds today for 50,000 rupees per and sell the same after 365 days at 55,000 rupees per. Then the profit or gain of 5,000 rupees per is considered as long-term capital gain. Generally speaking, gain or profit earned by investing into stocks or equity mutual funds and selling after 1 year from date of purchase can be categorized under LTCG. Currently in India, any gains realized and categorized as LTCG, equity and equity MF is completely exempt from taxes. In other words, tax on LTCG is at 0%. Do note, the purchase and sale of shares has to be conducted via a recognized exchange. Just to re-emphasize, if you had bought Infosys shares worth 1 rupee 10 years ago and sold the same today for 1 crore rupees, you don't have to pay any taxes on your gain or profit of 99 rupees. So, taxes on long-term capital gain of 99 rupees equals 0 or exempt if the investment and the consequent sale were done via an off-market transaction. Non-listed stocks, tax on LTCG is 20%, for example purchase and sale of shares belonging to startup companies by venture capitalists. Listed stocks, tax on LTCG 10%. Short-term capital gain, STCG. Assume you buy listed stocks or equity-oriented mutual funds today for 50,000 rupees per and sell the same within the period of 12 months. Say at 55,000 rupees per. Then the profit or gain of 5,000 rupees per is taxed as a short-term capital gain, STCG. Generally speaking, gain or profit earned by investing into stocks or equity mutual funds holding for more than 1 day, also called delivery-based, and selling them within 12 months from date of purchase can be categorized under STCG. Currently, tax on STCG in India is flat 15% on the gain or profit from sale of shares or equity-oriented mutual fund. Therefore, if you buy Infosys shares worth 100,000 rupees per today and sell the same 10 days later for 120,000 rupees per, then you are liable to pay 15% on 20,000 rupees STCG or 3,000 rupees per as taxes. So, tax on short-term capital gain equals flat 15% of the gain, profit, listed stocks. Speculative business income, as per Section 43(5) of the Income Tax Act, 1961. Profits earned by trading equity or stocks for intraday or non-delivery is categorized under speculative business income. There is no fixed rate like capital gains tax rate when you have a business income. If you have a business income, it has to be added to the rest of your other income and tax has to be paid as per the tax slab you fall in. For example, assume for the financial year my profit from trading intraday stocks was Rs. 100,000. And my salary for the year was 400,000 rupees per. So my total income for the year is 5 rupees and I have to pay taxes on this as per my tax slab. 25,000 rupees in this case as shown below. No. Slab taxable amount tax rate tax amount 10 to 250,000 rupees to 50,000 0% nil. To 250,000 to 5,000 to 50,000 10% 25,000. Total tax applicable Rs. 25,000. So the point here is that one needs to club the speculative business income with other income source and identify the taxable amount. Once this is done, tax has to be paid based on the tax slab one belongs to. Non-speculative business income. Income from trading futures and options on recognized exchanges, equity, commodity, and currency is categorized under non-speculative business income as per Section 43(5) of the Income Tax Act, 1961. Like discussed earlier, business income has no fixed tax rate. You are required to add the non-speculative business income to all your other income and pay taxes according to the slab applicable to you. For example, assume a trader cum hotelier earns Rs. 500,000 by trading F&O. Besides this, assume he also earns 20 rupees from his hotel business. Therefore his total income for the year is 25 rupees 500,000 rupees plus 20 rupees and therefore his tax obligation is as follows. SL No. Slab taxable amount tax rate tax amount 10 to 250,000 rupees to 50,000 0% nil. 250,000 to 500,000 to 50,000 10% 25,000. 500,000 to 1,500,000 20% 1,000,000. 410,000 to 25,000 15,000 30% for 50,000. Total tax applicable 575,000 rupees. Effectively, the businessman here is paying 30% of his F&O profits as taxes. You would be wondering why trading equity intraday is considered speculative, but trading F&O is considered non-speculative. When trading intraday, there is no intention of taking delivery, and hence it is considered speculative business. F&O is defined as non-speculative by the government. Maybe as they can be used for hedging and also for giving delivery of the underlying contract, even though currently equity and currency derivatives in India are all cash settled. But by definition they give rise to taking delivery. Certain commodity F&O contracts like gold have delivery option to it. 3.2 Pros and cons of declaring trading as a business income. Let us look at the bright side first. Here is a list of advantages of declaring trading as a business income. Low tax if the total income, trading plus any other, is less than 250,000 rupees per. Then there is no tax implication, and if less than 500,000 rupees per, effectively one has to pay less than 10% of income as tax. Claim expense. One can claim benefit of all expenses incurred for the business of trading, while for capital gains only charges on your contract note other than STT can be claimed. For example, brokerage charges, STT, other statutory taxes while trading, internet, phone, newspapers, depreciation of computers and electronics, research reports, books, advisory, etc. Offset the loss with gains if one incurs any non-speculative F&O trading loss. This can be set off against any income other than salary. For example, if I incur 5 rupees loss in trading F&O and my other income, like rent and interest, excluding salary, is 10 rupees I will have to now pay tax only on 5 rupees Carry forward the F&O loss if there is net loss any year, non-speculative F&O plus any income other than salary. And if income tax returns are filed before due date, loss can be carried forward for the next 8 years. During the next 8 years, this loss can be set off against any other business gain, non-speculative business income. For example, if you had net loss of 5 rupees this year trading F&O which was declared on time, you can carry forward this loss next year, and assuming you made a profit of 20 rupees next year, you can set off the previous year's 5 rupees loss and pay taxes only on 15 rupees Carry forward your intraday equity loss. Any speculative or intraday equity trading loss can be set off only against any other speculative gain. Note: you cannot set off intraday equity trading loss which is considered speculative with F&O trading, which is considered non-speculative. Speculative losses can be carried forward for 4 years if the returns are filed on time. So assume an equity intraday trader makes a loss of 100,000 rupees per this year. He cannot offset this against any other business income. However, he can carry it forward to the next year up to 4 years. Assume the next year he makes a profit of 50,000 rupees per by trading equity intraday. Then in that case he can use the previous year's 100,000 rupees per loss to offset the complete gains of this year, 50,000 rupees. The balance loss of 50,000 rupees per can still be carried forward to the next 3 years. So do note, partial offset of losses is possible. The following table summarizes the above points. Head of income under which loss is incurred, whether loss can be set off within the same year, whether losses can be carried forward and set off in subsequent years, time limit for carry forward and set off of losses. Under the same head, under any other head, under the same head, under any other head. Losses of F&O as a trader, yes, 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 no, 8 years. Speculation business, yes, no, 4 years. Capital gain, short term, yes, no, 8 years. Now, here is a set of drawbacks for declaring your business income. Potentially high taxes. If you fall under the 30% tax slab, you will effectively pay 30% of all your trading profits as taxes. ITR forms. Declaring business income would mean having to use an ITR 4 or 4S, which would mean needing help of a CA to file your IT returns. This can be an added effort and cost, especially for those salaried people whom I have been using the very easy ITR 1 or ITR 2. We will discuss more on this topic in the chapter on ITR forms. Audit. Having to maintain the book of accounts which will need to be audited if your turnover goes above 2 crore rupees, was 1 crore rupees until FY 15/16 for a year, or if your profit is less than 8% of your turnover. We will discuss more on this topic in the chapter on turnover. 3.3 What are you? Trader, investor, or both? Coming back to our original discussion. According to CBDT, investor, anyone who invests with the intention of earning through dividends. Trader, anyone who buys and sells with the intention of profiting from the price rise. As an investor, you can claim all your delivery-based equity gains, profit, to be capital gains. But as a trader, it becomes your business income, which has its own pros and cons as discussed above. The rule is very clear with respect to F&O trading and intraday equity trading. F&O trading has to be considered as a non-speculative business, and intraday equity as a speculative business. So if you trade these instruments, you have to use ITR 4 for filing IT returns. So even if you are salaried, you have to compulsorily use ITR 4 and declare this income, profit or loss, from trading as a business. Unlike what most people think, losses also is recommended to be declared. Hiding trading activity on the exchange from the IT department could mean trouble, especially in case of any IT scrutiny. IT scrutiny is when the assessing income tax officer demands you to meet him and give an explanation on your IT returns. The chances of getting a call for scrutiny is higher when the IT department systems, algorithms pick up trading activity on your PAN, but the same not declared on your ITR. For equity delivery-based investments, if you are holding stocks for more than a year, you would have received some kind of dividend, and even if you didn't, you can show them all as investments and claim exemption under the long-term capital gain. If you are buying and selling stocks frequently, yes, it is an open statement. But there is no rule which quantifies frequent for shorter terms. It is best to declare that as non-speculative business income instead of STCG. Another thing to keep in mind is that if investing, trading on the markets is your only source of income, and even if your trading activity is moderate, it is best to classify income from all your equity trades as a business income instead of capital gains. On the other hand, if you are salaried or have some other business as your primary source of business, it becomes easier to show your equity trades as capital gains even if the frequency is slightly higher. Thankfully, one thing that the circular clarified was that you can be a trader and investor both at the same time. So you can have stocks meant as investment for long-term, and stocks meant for shorter-term trades. Just because you indulge in a lot of shorter-term trades wouldn't necessarily convert all your longer-term holdings or investments into trades and therefore bring those long-term gains under business income. But it is important to clearly demarcate your trading and investment portfolio while filing returns. Similarly, if you are trading F&O or intraday equity trading, you compulsorily have to classify yourself as a trader. But you can still show your long-term investments under the capital gains head to get the benefit of LTCG being exempt from taxes. So, you can be an investor, trader, or both. But make sure to keep the above points in mind, and do consult a chartered accountant before filing returns. Even though this might seem confusing, Rules are made for 1% of the population that is trying to break them. As long as your intent is right. You know the basic concerns of the IT department and keep those in mind while filing IT returns. It is quite simple. But stay consistent with the way you classify yourself. Don't keep switching between being an investor or a trader to declare your equity short-term trades. If you follow these simple rules, let me assure you, there is no need to fear the tax man. Before we wrap this chapter, here are some interesting links that you should read through. CBDT's circular on distinction between trades and investments. Business Standard is your return from stocks, capital gains, or business income. Economic Times, are you a stock trader or an investor? Tax Zero, income from share trading, business or capital gain? Money Control, investor or trader? The argument continues. Economic Times, Budget 2014 clarifies that commodity trading on recognized exchanges is non-speculative. Economic Times, new data mining tool may access PAN-based information of taxpayers. Help check evasion. Key takeaways from this chapter. Trading F&O, equity, currency, commodity is considered non-speculative business. Trading intraday equity is considered speculative business. Equity holdings for more than 1 year is considered long-term capital gain, LTCG. Equity holdings between 1 day to 1 year with low frequency of trades is considered short-term capital gain, STCG. Else in case of high frequency of trades it should be considered as non-speculative business income. Disclaimer, do consult a chartered accountant, CA, before filing your returns. The content above is in the context of taxation for retail individual investors, traders only.